Hello everyone, welcome back to the course Strategic Management Accounting. This is topic 3, Strategy in the Market, Strategic Pricing Decisions. As we discussed in our previous lectures, there are 3 interrelated domains or sites of strategic actions in which you can enable and enact your strategies: the market, point of production, and the organizational hierarchy. Of these 3 domains of strategic actions, the market is the most critical and important. That is because, as we already discussed in the previous lectures, the strategy ultimately involves positioning your brand, your product, or your services in the market in comparison to the brands, products, and services that your competitors offer in the market. In that sense, strategy involves creating, maintaining, and sustaining a particular positioning in the market over your competitors so that you can gain a competitive advantage for a sustained period of time. In pursuing such a strategic position, you may follow, for example, according to Michael Porter, a cost leadership strategy or a differentiation strategy in a narrow market scope or a broad market scope. Whatever the strategy that you would follow, pricing is a very critical, important marketing variable, strategy variable. Together with other marketing variables such as product, place, and promotion, the price plays a very critical role in your positioning strategy. That is because the price is the denominator of the value for money equation, which affect not only the cost leadership strategy but also a differentiation strategy that is to be established through any means of differentiation other than the price. So whether it is cost leadership, whether it is differentiation strategy, still price plays a critical role. And price is a key variable through which customers understand and judge the value or the value for money that they would gain from your brand, from your product, or from your services. So, pricing is a strategic act which has to be enabled and enacted in the market. Not only that, pricing is important because pricing is the only variable through which the revenue or sales is generated. The pricing is the only variable through which you can make sure that you can have a sufficient profit, a sufficient return on your investment. So, of all other strategic acts you would carry out in the market, at the point of production, within the hierarchy, it is the price, only the price, which generate income. Therefore, you have to be very strategic in setting your price. On the one hand, it should capture the market dynamics and it should enable and enact a particular positioning strategy. And on the other hand, the price should enable you to earn a sufficient profit, a sufficient return on investment. So that is the critical importance of pricing as a strategic variable. So this topic is about strategic pricing. And this topic is organized around three main learning objectives. The first one is, before we move on to discuss the specific factors and processes of strategic pricing, we would have a discussion about how pricing is conceptualized, how pricing is carried out in conventional economic models, in conventional management accounting models. So therefore, we first explain and understand how pricing is carried out, how pricing is conceptualized in conventional neoclassical economics and conventional management accounting. Then, secondly, we will talk about the specific set of processes that you have to follow, or the specific set of actions that you have to carry out, and a specific set of factors that you have to consider when you are going to use price as a strategic variable, when you are going to pursue strategic pricing. That is our second learning objectives. Then thirdly, we will pay a special attention to a couple of management accounting or costing techniques, namely life cycle costing and target costing. We will talk about how these costing techniques, life cycle costing and target costing, can be used in strategic pricing. So these are the three learning objectives that we are trying to achieve by following this lecture and by reading the recommended readings for this particular topic. Now, let's talk about neoclassical economic models of pricing. I know you have already studied neoclassical economic models in your previous economic lectures. However, let me refresh your mind. Let me provide a particular interpretation based upon which we can further advance our understanding of strategic pricing in this lecture. According to neoclassical economics, a firm's objective is understood to be maximization of profit. Accordingly, neoclassical economics assumes that a firm should make every decision in order to maximize profit. A firm would decide its price with the aim of maximizing profit. A firm would decide the quantity to be produced and sold, the production capacity to be used with the aim of maximizing profit. Then, neoclassical economics has a mathematical proposition about profit maximization. That is, profit will be maximized when the marginal revenue is equal to marginal cost. In other words, profit will be maximized when the extra income that you can generate by producing and selling an extra unit of your good or service is equal to the extra cost that you have to incur to produce that extra unit. And this mathematical proposition of profit maximization is explained by this diagram, which you have seen many times in your previous economics and management accounting courses. Now, according to this model, demand curve approximate, estimate, and bring the market in to the decision-making framework. The market, the domain or the site of strategic action in which you position your brand, you position your product, and you position your services, appear in this neoclassical economic model of pricing as the demand curve. The demand is conceptualized as the causal connection or the causal relationship between the price and the quantity to be sold. So you learned when you set a higher price, the quantity that you can sell would be lower. And if you set your price lower, you can sell a higher quantity. And this negative connection between price and the quantity to be sold is further explained, further conceptualized by the concept of price elasticity of demand. Then you would decide your price on the basis of this demand curve, which or based upon which you can derive your marginal revenue curve. So to refresh your mind, we have a demand curve, and from that demand curve, we would derive our marginal revenue curve. And then we decide the best price by matching this demand condition with our point of production, the cost curves. So while the demand curve brings the market into our decision-making model, the cost curves brings the point of production into the decision-making model. So we have the average cost and the marginal cost curves. And accordingly, we determine our price as the point in which the marginal revenue equates to marginal cost. So that is the neoclassical model of pricing. To repeat and summarize, this neoclassical economic model of pricing brings the market, approximate or estimate the market through the demand curve and the marginal revenue curve. And then this model brings the production function, the point of production, to the decision-making model through the cost curves, average cost curve and the marginal cost curve. Then, by matching them together, by putting them together, by finding the point at which the marginal revenue equal to marginal cost, we determine the price. And that price would be the profit maximizing price. Now, in order to appreciate the real strategic processes, actions through which we establish a particular strategic position in the market, we need to develop an understanding beyond this neoclassical economic model. And we have to understand the limitations of this neoclassical economic model. And this neoclassical economic model can only provide a very limited, very narrow, and a problematic understanding of the way the firms actually decide or determine their prices. in a strategic sense as a strategic variable. One of the key limitation of this particular model is the assumption of profit maximization. As we just understood, this particular model is based on the assumption that the firms are trying to maximize profit. When you look at the real world decision making conditions, real world decision making scenarios, this profit maximization objective become rather problematic. We have seen, or you can easily understand, that many companies are even happy to incur certain losses at the introductory period of a product. And they would set introductory prices not good enough to earn a sufficient profit, or even not good enough to earn a profit at all. And then even in other conditions, not even in the introductory phases of a product, in mature stages of the product, a firm would not thinking about maximizing profit. Instead, most of the time, firms would be more than happy with a target profit, a satisfactory level of return on investment. And in most of the occasions, the firms would not consider the profit maximization is the ultimate objective at all. Instead, they would have a specific profit targets, a specific profit objectives, depending upon the specific strategic conditions that they are facing. So that is the first point, based upon which we can develop a critique on the neoclassical economic model. The assumption of profit maximization is problematic. And secondly, this neoclassical economic model conceptualizes the market, incorporates the market, brings the market into the decision-making model only through the demand curve. Accordingly, the market is conceptualized simply as the causal connection between price and the quantity. And this is a very limited understanding of the market and the competitive terrain. As we discussed in our previous lectures, in strategic sense, the competitive terrain, industry, or the market is much more complicated than that. The demand is much more complicated than that. And this competitive terrain constitutes of so many factors, so many forces, so many parties, and so many dynamics, including our own strengths and weaknesses, our own perspectives about the strategy, our competitors' strengths and weaknesses, and our competitors' possible strategic moves, and then the customer base in terms of their demographic, political, economic, legal, cultural characteristics. And then we also have various dynamics associated with our supply chain and the wider regulatory and governance infrastructure. So, in a strategic term, the market or the competitive terrain is much more complicated than what this economic model presumes, what this economic model can conceptualize. And then, according to this economic model, the firm has very limited or no strategic agency. A firm would decide its price depending on the conditions imposed by the demand curve. At It's best a firm can decide the price only on the curve, sacrificing the quantity. So the demand curve is taken as a constraint. Demand curve is a kind of a structural imposition, and the price has to be decided based upon that structural imposition. So there is no strategic capacity, strategic agency for the firm. And we discussed this problem of neoclassical economic models when we were talking about the structure, conduct, performance model in our previous lecture. And we explained and we discussed how Michael Porter wanted to revise that particular model so that the firm can be attributed with a particular or more strategic agency. And there we studied and understood that firms do have a strategic agency. Firms can create their own markets. And firms can recreate, reproduce, change the structural conditions within which the firms operate through the firm's strategic actions, through the way the firms enact and enable their strategies. A firm would gain a strategic agency, capacity to change the structural conditions upon which they operate based upon their past performance, based upon their strategic moves. And this neoclassical economic model does not provide, does not conceptualize such a strategic agency. Then, finally, we can develop a critique on this neoclassical model on the basis that this neoclassical economic model considers pricing as a singular decision, which can be done on its own. But when we are going to think about strategic pricing, pricing as a strategic variable, pricing as a strategic action through which you enable and enact a particular positioning strategy, pricing cannot be and shouldn't be or should not be carried out in its own, in isolation, as a singular variable. Instead, pricing should always be considered together with other marketing variables or marketing decisions that you are going to make, such as your product decisions, your promotion decisions, and your place decisions or distribution decisions. Pricing is only a one decision that has to be made in association with lots of other decisions. And it is all these decisions as a total package, as a collection, which determine your positioning in the market. So, pricing is not an individual, singular decision to be made. It has to be associated with all other positioning decisions that you would make in the market as well as at the point of production. So, in brief, to summarize, this neoclassical model of pricing can be critiqued in terms of its assumption about profit maximization objective and in terms of the way it incorporates, the way it conceptualizes the market through the demand curve, and in terms of the very limited or no agency that it attributes to the firm as a strategic actor in the competitive terrain. And finally, this model can be critiqued on the basis of the fact that this model only considers pricing as a singular decision that can be made. So that is our discussion about neoclassical economic model of pricing. Now, let's talk about the accounting model of pricing, which you have already studied in your previous management accounting courses as cost plus pricing. According to this model, the price is estimated by adding a required profit margin to the cost. And this required profit margin is given to the accountant by the top management. Therefore, the accountant's biggest challenge is the estimation or calculation of the cost. In calculating the cost, accountants classify the cost into two categories: the direct cost and the indirect or overhead cost. The calculation of direct cost is not the biggest challenge. Most of the time, the accounting information system, the transaction processing system, and the other operations management system provide the relevant information to calculate the direct cost, such as direct labor cost, direct material cost, and the direct overheads incurred at the factory floor. The real challenge is calculation of overhead relevant for a given cost unit. This is the problem of overhead absorption. As you know, a large amount of overhead is incurred all over the organization, across the organization. And we need to absorb all these costs into the relevant cost units. For that purpose, you may use traditional absorption costing techniques, in which case you may use, for example, direct labor cost, direct material cost, prime cost, and so on as the basis upon which you absorb the overhead into the relevant cost unit. Or alternatively, to absorb that cost to the relevant cost units, you may use activity-based costing, more refined, more advanced, and perhaps more accurate method of tracing the overhead cost to relevant cost units. In this case, you trace the overhead on the basis of a set of activities relevant for each cost units. And you understand activities provide a better basis for absorption or trace of the cost. And you understand activities are the real drivers behind the cost. And therefore, activities provide a better insight, better understanding about the cost incurrence or the cost occurrence. And as a result, an activity-based analysis of cost would provide a better information to manage your cost strategically. We will talk about that in our forthcoming lecture, Strategic Cost Management. In an overall sense, the accounting model of pricing involves estimation of price by adding a required profit margin onto the cost. And the biggest challenge is estimating the cost in terms of direct cost as well as overhead cost. To estimate the overhead cost, you may use traditional absorption costing technique or activity-based costing technique. One of the key problems of this accounting model of pricing is that it has no consideration at all about the market, the ultimate site in which strategies are to be enacted and enabled, the ultimate site in which you have to position your brand, your products and services. As we discussed in our previous lectures, any sensible strategic approach should have a careful analysis of the market. When you are trying to decide the price for your product or service, together with other marketing variables such as product, place, and promotion, you need to have a careful analysis of the market, the competitive offerings, the customer profile, and so on. But this pricing technique, this accounting model of pricing, has no any consideration about the market. And this accounting model of pricing is totally production driven or production based, and it manifests a push strategy. What I mean by that is the firm would carry out producing its goods and services whatever the way the firm think the best. So in doing so, at the level of factory, at the point of production, they may incur lots of inefficiencies. They may have lots of wastages. And at the factory level, the production would keep on carrying like that, with wastages and with inefficiencies. Then you calculate your cost. And therefore, obviously, that cost will include all that inefficiencies, all that wastages. And then, on the top of that cost, as a percentage, you would add your profit margin. That means your profit margin will also include a percentage of all these inefficiencies and all these wastages. And you would profit from your own wastages and inefficiencies. And then you ask your customer to pay that price. You demand your customer to pay that price. So your customer has to pay all your inefficiencies, all your wastages, as well as a profit margin on that. So you dump all your inefficiencies, all your wastages, together with an added profit margin on them to the customer. So you are pushing all your wastages, all your inefficiencies, all your cost onto the customer. And the poor customer has to pay it. This may work. This may be able to deploy in a market where you are a monopoly or almost like a monopoly. Or your customers have no bargaining power over you. If the market is very competitive and if your competitors are managing their cost much better than you, and if you are trying to pursue a cost leadership strategy, and when your customers are having and enjoying a higher bargaining power over you, and if they are more sensitive towards the price, this pricing technique would not work. You can't simply dump all your inefficiencies, all your wastages, all your cost onto the customer. Customers would not take it, and your competitors would not let it happen. So in such a scenario, you have to rethink about your pricing. You have to start from the market and come back to the factory. You have to reverse this push strategy. You have to convert it into a pull strategy. And you have to adopt what we may call target costing system, which we will be discussing later in this lecture. Now, when it comes to strategic pricing, we have to emphasize two important points. The first one is the aim of pricing or the aim of strategic pricing is not simply to recover the cost and a profit margin. Yes, we should understand and we should appreciate recovering the cost and earning a profit margin is very important for the financial viability of a company. However, the ultimate aim of strategic pricing is more than that. The aim of strategic pricing is to enable and enact a particular strategic positioning in the market. And it is only through an effective strategic positioning in the market that the firm can recover its cost and earn a sufficient return on investment. So, the ultimate purpose of strategic pricing is to enable and enact a particular strategic positioning in the market. And that strategic positioning, for example, if we follow Michael Porter, could be differentiation or cost leadership in a narrow market scope or a broad market scope. Whatever your positioning may be, the pricing is there to enable and enact that particular positioning strategy. That is the first point we have to keep in our mind. And second point is that such a positioning cannot be enacted and enabled only by pricing. Pricing has to be effectively integrated with and coupled with other marketing variables, namely product, place, and promotion. In other words, a particular strategic positioning need to be enabled by the integrative use of marketing mix variables: price, place, promotion, and product, all four together, and with many other strategic decisions that you would do in the market and beyond the market. So pricing only in itself cannot enact a particular strategic positioning. It has to be effectively integrated with all other strategic decisions that we make. So these are the two key points or propositions that we have to keep in our mind when we are further discussing strategic pricing. You would understand that from the very beginning, from the very first lecture I did up to now, and even in my forthcoming lectures, I would be emphasizing, re-emphasizing and repeating the idea of positioning. I would be keep telling that ultimately strategy means positioning. So positioning your brand, your product, and your services in the market. And the concept of positioning will be the key concept, core concept, in reference to which we will try to understand everything else in strategic management accounting. So the notion of positioning becomes very critical concept, and it becomes the basic referential point in reference to which we try to understand, we try to interpret everything else. Now, when it comes to strategic pricing, we have to ask three fundamental questions about positioning. The first question is, where do we position? Second question is, what do we position? And third question is, how do we position? So these are very fundamental basic questions. But by answering these fundamental basic questions, we have a broad understanding about strategic positioning. So, getting back to our first question, where do we position? I already mentioned that in a very rough, approximate, or generic sense. Where do we position? We try to position our brand, product, and services in the market. So the market is the place in which we try to enable and enact our positioning. However, at this particular point, we need to have more refined concept or reconceptualization of the market. So in reference to the positioning, in reference to the way we are trying to use strategic price together with the place, product, and promotion to create a particular positioning strategy, we have to understand the notion of market in a different manner. We have to redefine and reconceptualize the market as a psychological construct. The market as the collective mindset of our customers. Now, we think about the market when it comes to positioning as the collective mindset of the customers. So, market as a psychological construct. So, in that sense, where do we position? We position in the mind of the customers. We position our brand, we position our product, and we position our services in the mind of the customers. So this notion of positioning in the mind of the customer is often spelled out by the marketing gurus as owning a word in the mind of the customer. So ultimately, positioning means you are trying to own a word in the mind of the customer. For example, BMW, in relation to their various products, would try to own the word luxury or performance. Or in relation to certain new products they are introduced into the market, the environmental friendliness. So those are certain keywords or certain key idea or a concept that they are trying to place in the mind of the customer in association with their brand, their product, or their services. So that's what we mean by ultimately positioning. Positioning is owning a word in the mind of the customer, associating a particular concept, an idea, or a word in the mind of the customer in relation to your product, your service, or your brand. So when you are thinking about positioning in that sense, positioning as psychological construction or psychological reconstruction in the mind of the customers, then you have to redefine and reconceptualize your brand, your product, and your services as ideas, concepts, or words. So your brand should represent a particular unique idea, or your product or service should represent a unique particular idea through which you differentiate. So in a broader sense, brand basically means a particular set of wording, symbolizing, coloring, and so on, through which you differentiate your product and services, your company from your competitors. So you create an image, psychological image. You create a set of words, phrases, messages, and so on, which you position in the mind of the customer. So in the mind of the customer, your product becomes different from the competitor's product. That is because you own a particular concept. You own a particular word. And that becomes your brand. That becomes your product. And that becomes your service. So that's the answer for the question, what do you position? And then thirdly, how do you position? So in this regard, you have to think about two things. The first thing is you position this word, idea, or concept in association with your product, goods or service or brand in the mind of the customer using the total marketing package, the marketing mix, not only the price but also place, promotion, and product. All these things together collectively are to be mobilized to own a word in the mind of the customer. And in doing that, you follow a particular process of marketing. You are following a particular strategic process, which we call STP marketing: segmentation, targeting, and positioning. So, the process through which you position your product, your brand, and your services as a particular concept, as a particular idea, as a particular word in the mind of the customer would take place through three steps: segmentation, targeting, and positioning, which we call STP marketing. So, when we are talking about segmentation, so as we discussed in the very first lecture on the strategic turn, with the neoliberalization of politics, globalization of markets, and digitalization and virtualization of technologies, we now have mega globalized markets. However, we also discussed that. I also mentioned that these mega globalized markets are not mass markets. These mega markets are highly stratified, highly segmented, highly differentiated markets. So in these kind of segmented, differentiated, stratified markets, a unique, singular, universal approach would not work. You can't position your brand, your product, or your service across all these segments with the same word, with the same concept, with the same strategy of positioning. Because the customers are not the same in all these segments. So therefore you have to identify the salient features or salient bases upon which your mega markets, these markets have been segmented, differentiated, and stratified. So identification of these stratifications in the market, identification of these segments or different segments in the market is what we call segmentation. So that you can think about each segment as a unique market, each segment as a unique space within which you have to follow a different positioning strategy. So how do you segment a market? How do you identify these market segments? In a broader sense, we can think about 4 different variables based upon which segmentation can be done. The first segmentation variable is what we generally call demographic. So demographic segmentation include segmenting the market on the basis of, for example, age groups, marital status, ethnicity, and so on. So these are what you call demographic variables. And then second variable according to which you may segment your market is called geographic variables. Nation states or certain countries as a separate market, regions, climatic regions, and so on. So you may have different product, services, and different marketing strategies for different countries, different regions, and different climatic conditional zones. So that is what we call geographic segmentation. And then third segmentation variable may be psychographic segmentation. So you may use different psychographic variables to segment the market. For example, customer attitudes, value systems, belief systems, and personality, and so on. So on that basis, you segment the market. And ultimately, you can have the fourth variable according to which you may segment your market is behavioral. So this may include, for example, the consumption rate, consumption timing, seasonal behaviors of the customers, as well as, most importantly, the benefit sought. So these are the four segmentation variables which we often see in various marketing textbooks. And these are the variables that marketeers often use to segment markets. And of these segmentation variables, benefit sought, which is coming under behavioral category. The benefit sought is one of the very important segmentation variable. And it seems that the companies are now increasingly thinking about segmenting the market on the basis of benefit sought. That means actually what the customers are looking for, your product or your service or your brand. What are they ultimately demanding? What kind of benefit they want from your product? Now to explain this, let's take the example of toothpaste market. A classic good example of explaining the notion of benefit sought or the segmentation of the market on the basis of benefit sought. So you ask the basic question, why do customers buy toothpaste? What is the specific benefit that customers want from using a toothpaste? So if I ask, why do you use toothpaste? The toothpaste manufacturers and the marketeers understand that there are three different, though interrelated, benefits that they are looking for. So the first segment, first category of customers are asking something to fight against the decay. So they call this particular segment, this particular group of customers as decay fighters. They want healthy gums, healthy set of teeth. So that is what they are looking for. So they are called decay fighters. And then second group is called whiter seekers. They want a whiter set of teeth. So they use predominantly they use toothpaste to make their teeth whiter, smile. And then the third category is called fresh breathers. They want to be very close to the others, as close as possible without a bad breath. So for example, a toothpaste like Close Up try to penetrate into this particular market segment. So those are the three categories that the toothpaste manufacturers, marketeers often segment their markets into: decay fighters, whiter seekers, and fresh breathers. And then, when we are trying to answer the question, how do they position their product or brand in this particular segment of the market? So they target. So they specifically target each of these segments. Targeting basically means designing a unique, specific, different positioning strategy, a positioning approach with your marketing mix variables, so that you have a targeted approach for each segment. So you are not trying to hit all these segments with a one approach. So you will have a unique, specific marketing strategy, a positioning strategy for each segment. And that positioning strategy, as I mentioned earlier, is not only price but also the effective combined integrated use of your product, place, promotion, and the price. For example, when we are talking about the toothpaste industry, toothpaste market, segmented into these three key segments. So you understand certain producers design their product, a variation of their product, a variety of their product, so that it appears as a medicinal product, a druggy product. So they will have a white toothpaste with a red line, with a kind of a medicinal taste, so they get the feeling that they are protecting their gums, they are protecting their teeth. And the advertising campaign might be using a dentist talking about the product, or having a kind of advertisement to say that so that particular toothpaste will build a protective cover over your teeth. So that is how they design the product and how they promote the product to that particular segment, and together with an appropriate price. And then when it comes to, for example, fresh breathers, your advertising would be rather different. Your advertising would be set of people, dancing together, being very close together, kissing each other, so you do not have fear of bad breath. Classic example is the close-up toothpaste. Even the name close up. And then thirdly, you may see the whiter seekers. Another design of your product to show that so this particular toothpaste make your teeth whiter and attractive. So that's the type of advertisement, and the product design and everything would be there. So you understand the notion of benefit sort and how the market would be segmented on the basis of this benefit sort. So that's what you mean by segmentation and targeting and positioning. So to repeat it again, the strategic pricing would follow an STP approach: segmentation, targeting, and positioning. You should first identify the basis upon which your market is segmented. The market is stratified. And such basis could be demographic, geographic, psychographic, or behavioral, including the benefit sort. And once you identify your segments, then you have to design your positioning strategy. That means all your marketing variables, place, product, price, and promotion all together to hit that particular target. So for each and every segment, therefore, you would have a different price, different product, different promotion strategy, and a different placement or distribution strategy. So that is STP marketing. So that is strategic pricing. So in an overall sense, to repeat what we discussed so far about strategic pricing, the ultimate aim of strategic pricing is enabling and enacting a particular positioning strategy. It is much more than recovering your cost and a profit margin. And in enabling and enacting such a positioning strategy, you have to use the price together with other marketing variables. And when we are thinking about pricing for positioning, we have to understand the notion of positioning. The positioning has to be understood in relation to three fundamental questions. Where do you position? What do you position? How do you position? Where do you position? Then we have to redefine, reconceptualize the market as a psychological construct, as a collective mind of the customer. So you position your brand, your product and your services in the mind of the customer. In doing that, your product, your brand, your services would become a concept, an idea, or a word. So you own a word in the mind of the customer. So what do you position? A word, an idea, or a concept through which you define your brand, your product, and your services in the mind of the customer. And then finally, how do you position? Using integrative use of all marketing mix variables through the process of segmentation, targeting, and positioning. So this STP marketing signifies that you cannot have one unique, universal approach of positioning to the market, because markets are highly fragmented, highly differentiated, highly segmented. So therefore, you need to design and develop a specific positioning strategy for each segment. So that is strategic pricing, which cannot be discussed on its own without talking about the positioning as a grand strategy and other marketing variables and segmentation, targeting, and positioning. At the very beginning of this lecture, I mentioned that this topic, the strategy in the market, strategic pricing decisions, would be structured around 3 learning objectives. The first one was to understand and explain neoclassical economic model of pricing and the accounting model of pricing, together with their weaknesses, their limitations. The second learning objective was to understand and explain the strategic process of pricing or strategic pricing, the process that we have to follow and the factors that we have to consider when approaching pricing as a strategic act through which we enable and enact a particular positioning in the market. And the third learning objective is to explain and understand the specific strategic role that a couple of costing techniques can play, namely life cycle costing and target costing. So as you understand, the first and second learning objectives were covered in this lecture so far. And I leave the third learning objective for the next lecture, the part 2 of this particular topic. And until that, thank you very much for following this lecture and see you again in the next lecture.